Excellent, excellent. I got it. Thank you. Okay, so without further ado, we'll be starting this session. And as you guys are aware that it is all important session on UAE-CET, and it is our first webinar in this series. For those of you who are first time here, my name is Farooq. I'm the CEO of Linchpin Training and Consulting. We are a specialized tax firm here in Dubai. And I'm a chartered accountant, and for last around 18 years, I am in Dubai, and I've been earlier with the bank here, and at present, for last over a decade, I am into with this training and the consulting side. So, okay, as you guys are aware that the CET has been issued in this month itself. So the overall idea for this session is to give you the main points of UAE-CET, which are applicable on most of the entities here. You can place your queries in the Q&A section. At the end of this session, I'll be answering each of these. So to start with, first we'll see the overview. CET. So basically, corporate tax is an indirect, is a direct tax which is implemented on the profits of an entity, and it's implemented on the taxable profits. So the CET was announced about a year ago at the start of this year, and it was in Jan, and it will be applicable on the financial year which is starting on or after 1st of June 23. So from the next year, the corporate tax will be applicable. And if we see it, the timeline, the CET is issued in December in this year, applicable from June next year. Its applicability on your financial year is on those financial years which are starting on or after 1st of June 23. And the filing of first CET return, it would be after the end of 9 months from the end of the X period. Now, in this case, the example is that if your financial year is starting in July, which will be next year, the financial year would be ending in June 2024. Okay. Okay, Rabi, you need to check at your end. Please give me a yes if you guys can hear me appropriately, or if there is any sort of a distortion, please confirm me in the chat that everybody can hear me. Okay. Okay. Thank you, Asha. Yes. So you need to check at your end, Rabi. So if my financial year is ending in June, my first year on which the CET will be applicable would be the financial year starting from July 2023. Because CET is applicable on or after the financial years which are starting from 1st of June 2023. Another example here is that if my financial year, which in most of the entities here in in UAE are having, if it starts from Jan, it's in December. So in this case, my first financial year on which it would be applicable would be starting from Jan 2024. So it means my first CET filing would be in 2025 if my financial year starts from Jan. I hope it is clear. Please give me a yes in the chat box if this is clear. Please give me a yes. Okay. Thank you, Shamjad. Now, it would be a federal taxation, which means it will be applicable across all the Emirates. And the administrative authority, of course, is FTA, and the competent authority, which is actually issuing, all this. Okay, CET here is Ministry of Finance. It is same as we have for VAT. Okay, here comes the skeleton. The skeleton is that the CT has been issued in the form of sections. Here are 20 sections in total in the law, and we have just segregated them, as they are falling into the same area. So the first 4 are basically for definition and tax cases, which includes your imposition, your category of exempt and taxables. Then we have got free zones, and we have got the the calculations, and we do have the adjustments, okay, from the income grouping, which is very, very important. It is the most complex area, that if you are part of a group, how you can treat the the transactions. And we have got the calculations, and finally we have the admin areas, where we have the information about the the fines and filings. So it would be a central skeleton. In case if you would be requiring to refer any area, you can easily get say a hint out of it. Scope and applicability. So far CT will be applicable almost on all the entities in UAE, with very few exceptions, okay, which I'll be explaining you shortly. So even if you are a business or you are individual, you will fall in in this category, and I'll explain you how. First, if you are a business incorporated, and the first check what you have to see that if you are falling under any exempt category. If yes, CT will not be applicable on you. For example, if you are a government entity or a fully owned state-owned entity. Next, if you are individual, and if you conduct a business or a business activity, which means you may be a freelancer here, you may be having a small business of your own, except if you are earning salary income only, it will not be applicable. But if there is any income which is kind of a business activity, CT will be applicable on that. So it means all those individuals who are having any business, CT would still be applicable. Okay, now in case if you guys have any query, please, you can find the Q&A section here. You can just place it at the end of the session. I'll definitely answer all of that. What would be the rates? So if you are a mainland company, your any income which is below 375K, CT will be applicable at 0%. So if your the taxable income is up to 375K, technically you won't be paying any tax here. But any income exceeding 375K, a flat rate of 9% is applicable. And if you are a free zone entity, and if you are earning a qualifying income, okay, which I'll explain you afterwards, 0% would be applicable on all of your qualifying income. But anything excluding the qualifying income, again, the flat rate would be applicable. So in simple form, we have got only 2 rates here, 0 and 9. So we'll see a small example here. So if my taxable income in a given year is 400,000, first 375 of it would be at 0 rate. Okay, any amount exceeding 375K, which in this case would be 25K, I'll be taxed at a flat rate, and my tax payable in this case is 2250. Same thing will be applicable. At the end, I'll also show you how to do a small, calculation. But our focus is to calculate the taxable income. First 375 is 0%. Okay, any amount exceeding is 375K. Chapter 3 of CT explains us about the exempt categories. So here are, approximately 7-8 persons who are exempted. First two are if you are a government entity or if you are government controlled entity. These two would be exempted. If you are somebody who is conducting extractive business is that if you are exploring, extracting, or removing the natural resources, which mean oil, gas, or any such thing. And the second category of such businesses that if you are somebody who is engaged in non-extractive business also, which means if you are separating, treating, refining, or any such activity of natural resources, again you would be exempted. Shamshad, for the filing, we will still need to see that filing would still be applicable, but the assumption is that filing will also may not be required in this case, but you still need to maintain all accounting information to support your exemption. And somebody asked that recording will be available. Yes, it will be available. Next, if you are a charity organization, you will be exempted. If you are a qualifying investment fund, again exemption would be there. Or if you are a pension fund, again with certain sort of the conditions, you will still be exempted. And if you are somebody who is incorporated in the state and you are wholly owned by exempt entity and you are also carrying out the exempt activities exclusively for your holding company. So these people are exempted. Apart from these, all entities in UAE would be subject to CT. Let's now see the concept of corporate tax base. So the case is that CT is applicable on everyone who is a taxable person. And we have two types. Either you would be resident or you would be non-resident. Okay, so in this case, the treatment would be slightly different. So first we need to see who falls under this category. In this one, in this resident, we have three types: legal, natural, or foreign. So of course, anybody who is incorporated in UAE, including free zones, would be automatically be resident. Any individual who conducts a business or a business activity in UAE, it would also be resident. Next is foreign company. Now it is very important. Foreign company which is incorporated outside the UAE, but it is effectively controlled from UAE, that would still be considered as resident. So it means that if I have incorporated, for example, in some other country which is giving me 0% of taxes, and I am controlling the company from UAE, I would still be considered an entity incorporated here, and I would be subject to CT. Non-resident is anybody who, of course, will not fall in the first category. And these are all those entities who are having a permanent establishment in this country. First thing, incorporated outside, but are having the permanent establishment in this country, which could be a branch, an office, a factory, any such thing. Or they derive UAE sourced income. So they are generating the income from UAE companies, okay, or somebody who is staying in UAE, or if they are part of a group who is operating here, and again, they will be treated as non-resident. Now, the all important area is that the taxability. Now, in this case, those who fall in this category of residents will be taxed on their global income. Okay, so if I'm a company, all my income which I generate for this company from across the globe, I would be taxed. If I'm individual, in that case also, and I'm conducting a business, in this case also, all my global income for that company only would be taxable here in UAE. So it is the first category. Second one is, if I am non-resident here, only the income which is sourced from UAE would be taxable. Which means if I am a branch of a foreign entity operating here, only my income in this country would be taxed. Or for that, the income which is being generated by this branch will be taxed here. Okay, or the income which I am generating of being part of a group. Now, another very important area is that if I'm having an unincorporated partnership, which means I have just joined hand with somebody else and we have not incorporated it as a legal entity of its own, in that case, such unincorporated entities, which I'll call them as UIP, they will apply to FTA if they wish to be taxed as a company on their own. If FTA approved, they will be taxed as a business. If FTA will not approve or they won't apply to FTA, in that case, all partners will be taxed individually, which means the share of this UIP would be split between the owners. And in that case, the individual owners would be filing the CT return and paying the taxes. Now, in this case, specifically for UIPs, we have the allocation basis on which the income would be shared would be the basis on which they share the profits. So the individual owner, as and when he'll be filing it, he can claim his individual expenses, which he has, incurred in generating this specific business activity. Now, free zone persons. For free zone, at present, FTA has given a very, brief information about the treatment, which I'll explain you here. First thing is that you need to establish if you are, a qualifying free zone person. Is somebody who is incorporated in free zone and who meets all of the following conditions. First condition and the foremost is that you should be maintaining adequate substance in the state. It means you should have adequate substance, probably you can say a presence inside the zone, having the staff there and actually conducting the business out of it. And you derive the qualifying income. Now, this income is yet to be explained, but if we see the explanation, the consultation document, which was earlier, issued by the ministry here, we have certain, you can say certain sort of the hints. So it can be zone to zone income, any income from within the zone, and any exports from the zone. Okay, although it would get specific as and when we'll get the clarification from FTA in this regard. And also you should not have opted for to be taxed at the standard rate. And the if you are doing a transaction, you are following the arm's length, and transfer pricing also, which means that if you are having a group entity from zone and you are shifting some item to the inland, it should be on fair market, you can say the price. So it should not be given any undue, you can say, advantage to any of the entity. Next important area, which is applicable almost to everyone, is how we do this calculation. So very first thing is that we'll start from our accounting profit. So if we have incurred accounting profit, we will be adjusting it with certain items. And finally, we will be arriving at taxable profit itself. So it means that if my accounting income is 100K, I may need to adjust my accounting income. And in that case, after all these adjustments, the final amount would be my taxable income, and on that CT would be applicable. And I'll also explain you what sort of adjustment have to be in place. On what basis we can have the financial statements? So the preferred one is accrual basis. Of course, it has to be in compliance with IFRS. Okay, unless FTA is giving you option for on some other basis itself. And as an option, FTA can also allow you to prepare them on cash basis. Specifically, if you are a very small business, we have a separate section on it, and that FTA can specify certain exemption or adjustment to those who are very small businesses. So we may see that the smaller entities, a shop or something like this, maybe they would be having the option to prepare these statements on cash basis itself. Now, how to arrive our taxable income? Again, as I said, that we'll start with accounting profit, and we will adjust. The first adjustment which will be in place is unrealized gains or losses. Now, unrealized gain or losses, we may have the option in few cases, we can include them in our income on the basis of as and when we are getting them actually being realized. Okay, else, all the unrealized gains, we have the option to exclude them. Exempt income, which would not be subject to CT, so we would be excluding them. Okay, example is if it would be dividend. Intra-group transfers subject to certain conditions would also be exempt. And for those expenses which won't be allowed for tax purpose, of course, all those have to be adjusted. For example, certain categories of entertainment expenses, we have to exclude them. If there is any adjustment of transactions between the group entities, and if there are the connected persons, which means the officers, the owners, and all those of an entity, any incentive, if the FTA will be giving, it would also be adjusted. Harsha, import expenses, if you are incurring, you can claim those. So all these expenses you can adjust, and after adjusting it, you would be getting that your taxable income, which then of course would be subject to the tax. Okay, now the exempt income, which of course we just have a discussion that exempt income would be excluded. Now, exempt income, the first is dividends. So if we are getting any dividend from UAE based companies, it is fully exempt. So there is no condition involved. So if you are investing in a company and you are getting a dividend as a company, you would be exempted. Please, if you guys have any query, use Q&A section and I'll definitely answer at the end. And second is that if you are getting dividend from foreign entities, there are certain conditions on which this would also be exempted, which I'll explain you. If there are certain, other income, for example, capital gains, foreign exchange gains, all those things, or impairment gains, all these are also exempted. Income from foreign branch. So if I'm having a foreign branch, I can apply to FTA that I will claim its exemption. So it means in that case, I won't be including the income of my foreign branch here in UAE income calculation. And finally, income earned by an non-resident who are operating or leasing the aircrafts in UAE. Those are also exempt incomes. Now, specifically for this point number 2, dividend from foreign entity, there are certain conditions based on which it would be exempted. Your shareholding should be at least equal to or greater than 5% plus all the following conditions should be fulfilled. Very important, all of these conditions. Your holding period should be at least a year. Either you have already held it or you have intention to hold it for a year at least. And the company in which you have invested in some other country, it should also be taxed at least on the same rate, which is in UAE. Okay. Profit sharing should be at least equal to or greater than 5%. Or if that specific, investee company would be ultimately closed down, you will still get the 5%, out of it. So if all of these conditions are fulfilled in that scenario, this option number 2, which is dividend from foreign entities, is also exempted. There are certain adjustments which are specifically given by FTA for the corporate tax income, which include the first thing is that if you are transferring any assets or liabilities within a qualifying group, and if you are having any gain or a loss out of it, you may exclude it from your CT calculation. Now, this is important to understand that it's not about forming, a tax group. That is a separate area, which I'll explain you afterwards. If you are part of a, qualifying group, which means that if the shareholding is at least 75%, and you all are in UAE, nobody is exempted, your financial year is also same, and you follow the same accounting standards, in that case only, your intra-group transactions, which are for transfer of assets and liabilities, the gains would be excluded. Next adjustment also, which you can have as a relief, is if you are selling out the business, which in simple form, if you are doing a restructuring of the business. In that case, if you are transferring your entire business or any independent part of it, and in that case also, if all of the following conditions are fulfilled, such gains also would be excluded, which means that if you are supplying, if you are selling it or transferring it to somebody who has some stake in, in this country, either he is a resident person or somebody non-resident who is having a, a permanent the establishment, which is a PE in this country. You don't belong to free zone, very important area. And of course, the common one, that financial year has to be same, accounting standard also has to be same. Allowable deductions. There are certain expenditures which are allowable wholly if you have incurred it on the generation of the taxable income, okay, and which does not fall as capital in nature, which means the expenditure on fixed assets cannot be claimed in the same year upfront. Okay, Here are certain expenses which are non-deductible, specifically which somebody has not incurred for business. In that case also, you cannot claim that. And then if you have incurred certain expenses which are incurred on your exempt income, this would also will not be there. Losses which are not connected with the business also would not be considered here. If you have certain expenses which are incurred on both taxable and exempt income, in that case, you will split it and then specifically calculate the appropriate share of expenses. If you are incurring some interest expense, we have a specific clarification on this, that the interest expense will be claimed on net interest expense basis, which means I have interest income. I will subtract my expense on interest from this income. And on that basis, I will see that if my interest income is greater than interest expense, I don't need to do any other adjustment. So I can claim all my interest expense in this case. Else, if interest income, if my interest expense is greater than my interest income, in that case, I can claim the interest expense only up to 30% of my EBITDA, which is earning before interest, tax, depreciation, and amortization. This is an important area so that you can claim only up to 30% of your interest. Entertainment expenses. Entertainment expenses, which includes all of these examples, meals, accommodation, transportation, or any such expenses, you can claim only half of it. Now, one thing which is important here, these are only entertainment expenses which are incurred on the customers, shareholders, suppliers. It does not specify for staff. So we still have to wait and see that if the staff entertainment also will be treated in the same fashion, or staff entertainment would, ultimately would all be admissible. Expenditures which we cannot claim, these includes if you are giving any charities to somebody who is not in the list of qualifying business, qualifying public benefit entity, which means that if it is not approved by the cabinet, any charity, if we give to such entities, it won't be admissible. Fines, penalties, of course, if you pay anything, would not be applicable again. Bribes, it goes without saying, it won't be applicable. Dividends, which you are paying to the owners, it won't be applicable, or it won't be, admissible here. Amounts withdrawn by an individual from his business. So if you are carrying business in your individual capacity, sole ownership, anything you withdraw from it, you cannot claim it as an expense. Now, here is an important area that we'll wait and see for the clarification, that if an owner has formed a proper entity in the form of, let's say, LLC, and if the owner is withdrawing a salary, whether it would be, admissible, or not. I personally feel that if you are an incorporated entity, and if as an owner, I'm withdrawing a salary, which is fair, I believe that it would be admissible. But in this case, we still have to wait and see the clarification from FTA. The corporate tax, which is imposed, of course, you cannot claim it as, admissible expense. Input VAT, which was a recoverable VAT, in that case also you cannot claim it as your admissible expense. For all that input which you cannot claim, for example, if you are an exempt business, of course you cannot claim your input VAT. So such input VAT, it can be claimed as your admissible expense. And of course, any taxes which are imposed on somebody which are outside the state, you cannot claim that as your admissible expense, but you have a separate area to claim that, and I'll explain you all that also. Transaction with your related entities and connected persons, very important and very complex area. Of course, I'm just giving you a glimpse of it, but as and when we conduct the detailed trainings, this area will definitely cover a lot of specification which a company has to fulfill. So a related entity is something which is in which your shareholding is 50% or higher, and if you are individual, all your close relatives would also be considered as relative party. So the connected persons include the owners, director or officers, or any associated entity of these two. Now, any transaction with your connected persons and related parties should be at arm's length, fair price. You cannot give undue benefit out of it. Now, in case if you will be having loss, you can adjust it in future years, and you can adjust maximum of 75% of taxable income in that specific year. So it means that if in year 1 I have a loss and in year 2 I have a profit, so previous year's loss I can adjust, but only up to 75% of my taxable income in that year. Any excess which will be unused loss, I can carry forward indefinitely, and I can adjust it in my future years. So a small example here, as it is a bit complex area. So if my taxable income is 100K in this year, and from previous year I have a loss which I'm carrying forward, which is 125. Maximum which I can claim in this year against my taxable income would be 75% of it. So the amount which I'll be adjusting is 75,000, which is 100,000 multiplied by 75%. So my net income on which I will be taxed is 100K minus 75K would be here. And the balance amount out of this 125, which I cannot claim in this year, I can then carry forward, and I can claim it in my subsequent years. Tax group provisions, another important and very complex area, but I'm just giving you a gist of it. So the percentage based on which I can form a tax group is 95. So it means I should be sharing the profit in this ratio. I should have voting rights also, and the capital sharing also would be in the same percentage. And afterwards, I fulfill all of the following conditions, which are very specific, as we had a discussion earlier also, that all these should be entities operating in UAE. They should not be in free zone. The financial year has to be same. Accounting standards also have to be same in this case. The calculation of CT payable is, in this case, rates we already have an idea that 0 and 9%. FT has also introduced the concept of withholding tax. Now, in this scenario, withholding tax at present is 0%. Normally, it is applicable if you are paying to some entities which are outside the country. So we adjust their tax here, as in Saudi we have around 15%. But here at present it is 0. So it means that we don't have to deduct any taxes on payment of a foreign supplier, but in due course, it it can be implemented. Foreign tax credits. So if we have paid any taxes in some other country, and if UAE has a double taxation agreement with that country, in that scenario, we can claim the foreign tax credit in our final filing. Payment and refunds, you can pay the tax within 9 months of the end of your tax year, which means if we go back to our first slide, that if my financial year is starting in Jan, closing in December, so my first VAT, first CT return, the time I have is up to September 2025, because in December 24, my tax year will be ending, and after that I have got 9 months to pay out, and also the filing. Tax returns, although I'm sure that FTA would be having the format online, but they have already given a brief idea that on what basis the information which has to be included. So in that case, of course, the period, the information of taxpayer itself, submission date, accounting basis, either it is accrual or tax base amount of tax loss in case if there is any, and so on and so forth. So these are all the information which we are expecting to be included in the CT filing. Finally, the record keeping. The record keeping is you have to maintain all record, which of course covers your accounting information, which will include your financial statements, your you can say the bank statements, and including all of the records. And you need to maintain it for 7 years at least from the end of the financial year. Now, this covers up almost all the areas which you guys would be expecting, which are applicable on all the entities here in UAE. How you should get yourself equipped with that you would be in full compliance with the CT itself. Now, in this case, the very first thing which you have to do, and especially if you are a large entity, or if you are part of a group, your impact assessment is the first thing. The overall planning on what areas CT is impacting you, whether you would be able to claim certain expenses, or you will not be able to claim certain expenses, your income structure, your areas of incorporation, all those things is your impact assessment exercise. Second one is staff training, of course, very important, and the staff has to be trained, especially the staff which is with your accounts area. And of course, CT will be implemented, and in that you have to make certain changes. It may be your ERP systems, it may be your group structure, it may be the business split itself. After the implementation, there would be a review, of course, that it is all appropriately being done itself. And of course, ongoing support has to be in place, that which is for filing of the CT return and onward compliance. We at Lynchpin are basically, giving all these services, and we would be happy to assist you guys in this case. Plus also, for all of those who are still with us, which are quite a few, we at Lynchpin are also announcing a portal for UAE CT and VAT, which is the first of its kind in UAE, and it's called Tax Box. it would be a portal where you can have unlimited queries with us. You have full search of all X's ultimately, which at present include VAT and CT, where you get monthly Zoom calls also for the consultations, and where all the online trainings are also included. So it is a single subscription where everything is included. I'll just share a glimpse of it, and you can see at how useful it is. Let me share my screen first, please, and I will. Are you able to see my screen? Please confirm me in the chat box. Please confirm if you can see the screen of Xbox. Okay, excellent. Now you just have to go to this site, xbox.ai, and here you can see you have got two options. You can ask a query. So we have a form where you can select if you have UAE VAT, or for the corporate X itself, give the brief information. You can upload the information also in case you have a specific case. And we have separate packages if you are a tax consulting firm. And as soon as you'll be submitting it, immediately you will get a ticket number, and within same day hopefully you will get the answer also. Second important area which you get, which is a free thing at present also, is that you can search anything. For example, I want to search corporate tax group. Okay. And if I click on this, so it gives me all the articles where these specific words are placed. So, for example, corporate law article 42, taxable income of a tax group. You just click on this and you get exactly the article and all the information also for that. Similarly, you have VAT also here. So if there is anything on VAT, you can search it and it comes to specifically here.